Have you ever been told that the smartest retirement move is to sell the family home, downsize, and unlock your equity? It sounds logical. A smaller home means less maintenance, lower utility bills, fewer responsibilities, and extra cash in the bank. But what if that decision quietly triggers a chain reaction that costs far more than most retirees expect? Over the years, I've spoken with many retirees who believed downsizing would instantly improve their financial situation. What surprised them wasn't the move itself. It was discovering the hidden financial consequences that nobody discussed beforehand. Today, we're going to walk through 5 major financial impacts that can occur when a retiree sells a long-held home. Some happen immediately, some appear years later, and some can affect your family's financial future long after you're gone. By the end of this video, you'll understand why keeping a home can sometimes be one of the most financially efficient decisions in retirement, and why every retiree should run the numbers before putting that for sale sign in the yard. Before we begin, remember that this video is for educational purposes only. Tax laws change, every situation is unique, and you should always consult a qualified tax professional before making major financial decisions. Let's meet Margaret. Margaret is 71 years old and retired after a long career in education. She purchased her home decades ago for $120,000. Today, the property is worth approximately $520,000. Like many retirees, she isn't living an extravagant lifestyle. Her income comes from 3 sources: pension income, Social Security benefits, modest IRA withdrawals. Altogether, she brings in about $52,000 per year and enjoys a relatively efficient tax situation. Then one day, her daughter suggests something many families recommend. "Mom, why don't you sell the house? Move closer to us, buy something smaller, and keep the extra cash." The idea sounds reasonable. The house feels bigger than she needs. The yard requires work. A smaller place near family sounds appealing. So Margaret sells her home for $520,000 and purchases a condo for $350,000. At first glance, it looks like she has freed up $170,000. But that's when the real financial story begins. Let's look at the first major impact. Impact number 1, capital gains exposure. Margaret purchased her home for $120,000 and sold it for $520,000. That's a gain of $400,000. Fortunately, current tax rules provide a significant exclusion for primary residences. Because Margaret qualifies as a single homeowner who lived in the property for many years, a large portion of that gain may qualify for exclusion. However, depending on individual circumstances, remaining gains could still be subject to taxation. Many retirees focus on the sales price and forget to calculate the gain. That's a mistake. Before selling, it's important to understand original purchase price, eligible home improvements, current value, potential taxable gain. The difference can be substantial, and that's only the beginning. Impact number 2, higher Medicare costs later. This is one of the least understood consequences. Many retirees are surprised to learn that a large income event can affect future Medicare premiums. Here's why. Certain Medicare costs are based on income from prior years. When a large financial transaction increases income for a particular year, Medicare may later use that higher income figure when calculating premiums. The result? A retiree may experience higher healthcare costs even though the home sale happened years earlier. The timing often creates confusion because the increase doesn't arrive immediately. For many retirees, the connection between the home sale and future healthcare expenses isn't obvious until the bill arrives. Impact number 3. More Social Security income may become taxable. Another area retirees often overlook involves Social Security taxation. Certain income thresholds determine how much of a retiree's Social Security benefits may become taxable. When a major financial event significantly increases income in one year, it can influence these calculations. The retiree may receive exactly the same Social Security benefit amount. Nothing changes on the payment side. Yet more of those benefits may be included in taxable income calculations. Many people never realize this is happening because it doesn't appear as a separate charge. It simply becomes part of the overall tax picture. Impact number 4, transaction costs that quietly reduce equity. Most people think about taxes. Far fewer think about transaction costs. When selling a property, several expenses can reduce the amount of equity ultimately received. These may include real estate commissions, closing costs, legal fees, moving expenses, setup costs at the new property. Individually, these costs may seem manageable. Combined, they can become significant. The key point isn't that these expenses are unusual, it's that they only exist because the sale occurred. Every retiree should calculate these costs before deciding whether downsizing truly improves their financial position. Impact number 5. Property tax changes. Here's another surprise. Many long-term homeowners benefit from various local property tax protections, exemptions, or assessment limitations. After purchasing a new property, those benefits may change depending on state and local rules. Some retirees discover that their newer, smaller home actually carries a higher property tax burden than expected. That's why understanding local tax rules before moving is essential. What appears to be a lower-cost home doesn't always result in lower annual expenses, and these costs can continue year after year. The benefit many families never discuss. Now let's talk about something that rarely comes up during conversations about downsizing. Long-term homeowners may have estate planning considerations that deserve attention before selling. Current laws contain provisions that can affect how appreciated assets are treated when passed to heirs. The details vary depending on individual circumstances, state laws, ownership structure, and future legislation. But the important lesson is simple. Before selling a highly appreciated property, retirees should understand not only today's financial impact, but also the potential implications for future generations. This is a conversation worth having with a qualified estate planning professional. The real lesson. Does this mean downsizing is always a bad idea? Absolutely not. Many retirees move for excellent reasons: health concerns, accessibility needs, reduced maintenance, family support, lifestyle improvements. Sometimes moving is clearly the right decision, but the decision should be based on complete information. Too often, retirees focus only on the sale price and the cash they'll receive. They don't examine the broader financial picture. That's where costly surprises can happen. Before selling a long-held home, ask yourself 3 questions. First, what are the potential tax implications? Second, how could the sale affect future healthcare costs and retirement income planning? Third, have I compared the financial impact of staying versus moving? Those 3 questions alone can save retirees from making decisions based on incomplete information. Because when it comes to retirement planning, the smartest move isn't always the most obvious one. Sometimes the home you've owned for decades isn't just where you live. It may also be one of the most valuable financial assets in your retirement strategy. So before you downsize, run the numbers carefully, understand the full picture, and make the decision that works best for your goals, your family, and your future. Which of these 5 impacts surprised you the most? Let me know in the comments below. If you found this video helpful, don't forget to like, subscribe, and turn on notifications. And if you enjoy straightforward retirement and personal finance education explained in plain English, you're in the right place. Thanks for watching, and I'll see you in the next video.